It's the last Friday in November. Hello and welcome to Africa Business Weekly. I'm Akin Obake. This episode promises to be intriguing as we dive into key discussions that have shaped the business landscape in Africa. Let's get a sense of what's on the show today. We start off in Southern Africa, where we look at the online gaming space and how South Africa is proposing a 20% tax on gross gambling revenue. In East Africa, Somalia is in the news, fresh off a death clearance as it makes itself open for business. And in West Africa, it was an MPC week in Nigeria and Ghana, where we saw another rate cut by the Bank of Ghana. Let's get right into the show today. Karabo brings us up to speed with stories from the Southern African region.
Hello, Akin. Well, the rise of online gambling has triggered many debates in South Africa. In a country with subdued economic growth, it is no surprise that a significant portion of the population is looking to make a quick buck. However, with gambling platforms at the tips of our fingers, this creates more opportunity for addiction and shifts consumer spending priorities. The National Treasury has released a draft national online gambling tax discussion. It is proposing a 20% tax on gross gambling revenue from online betting. For more, CNBC Africa spoke to Christopher Axelson, the Deputy Director General for Tax and Financial Sector Policy at the National Treasury.
So, I think the main proposal here and the main reason for why we are doing this is to try and discourage this activity. As you mentioned, there are many social ills that come with excessive online gambling. It can lead to addiction, financial stress, mental health issues, other social issues. And we view this in a similar way to alcohol and tobacco. There could be good reasons for you to do it. You might have a lot of fun doing it. So it's not banned. But if you are going to do it, we want to try and discourage that activity as much as possible. So the main aim here is to try and reduce the excessive amount of online gambling that is taking place. But of course, we could get a lot of revenue as well. And if people aren't going to reduce those activities and we get a lot of revenue from this, then that revenue can be used for developmental and social expenditures, which is good for the rest of the country. So that's how we're looking at this. I don't think the tax itself is going to stop this type of activity, but it certainly can create the resources for government to then channel it back into social expenditures.
Okay, so it seems kind of indirect, because I was going to ask, by taking more money from these companies that are already making abundant levels and amounts of money, I don't see how that could actually filter through to the people that are actually using these gambling services. I think for me, from a layman's point of view, I would think maybe taxing the people's proceeds that they get from gambling would maybe discourage them. So this is not necessarily about a direct impact, but it's for more money to get into government so that you can actually engage in activities that prevent this behavior. Am I hearing it right?
Well, the first thing is, if government is saying, look, we're worried about this activity, that's the first thing that's a signal. So, for example, when we did the health promotion levy, it's government saying we are worried about excessive consumption of sugary beverages.
Yeah.
And there have been studies that have been done after the health promotion levy came in, that the price went up and people stopped drinking. But it was also a signal from government to say we're worried about it. And again, this is another signal on online gambling that we are worried about this. There could be a case because now if those companies get taxed and it hits their bottom line, they might not be able to offer as competitive returns or provide as many winnings for the bets.
Okay.
So hopefully consumers will then say, oh, is this really worth it? Because we're not getting as much back when we actually bet. So it might reduce their activity then. But as you say, it might not. And then in that case, we would get a lot of additional revenue and we can use that for the budget. Maybe other taxes don't need to go up as much if we impose this tax.
Okay, interesting. Talking about the current revenues, from the current provincial taxes, are those reflective of the robustness of growth in the gambling industry?
Yes, so it has gone up. And the numbers that you look at from the National Gambling Board are incredible. The growth in this industry is huge. And it's gone up to 1.5 trillion rand in bets wagered, although that does include recycling of bets. But then you've got about 75 billion rand in terms of gross gambling revenue in the industry. Now, that is a very large amount. Gross gambling revenue is the amount that is wagered minus the amount that's actually paid out. So that's what's left. for the industry. And the provincial governments do tax that amount, and they get a few billion on it. But those tax rates are generally between 6 and 9%, and they depend on the different type of gambling that actually takes place. We are only looking at online gambling, so we're not trying to change the tax regimes of or bingos or others.
South Africa's fourth biggest mobile network operator, Cell C, made its debut on the main board of the Johannesburg Stock Exchange as a separate and independent entity after years under Blue Label's ownership structure. The listing marks the sixth and final listing on the local boards this year. CNBC Africa reporter Palesa Mafukeng was on the ground and spoke to the CEO, George Mendes, for more on the company's growth plans. Let's listen in.
The market value will be what the market value is. I think given the structure of how we've got to market, we had a number of debt to equity conversions by our existing main shareholder. And so when you put the consolidation together and you look at the business on a pro forma, the market will give you a little bit more time to see how the results play out. So for us, it was less important about the absolute value, but more about being in the public, being in the space where the investment community can now get involved, and they'll judge us on the results going forward. And so for us, it's more important to be in the JSE rather than waiting for perfection and listing at the highest possible value.
And as I did mention earlier, that one thing that did stick with me from your speech this morning is that you say Cell C is the telco of the future. If you can just speak to me about what your growth plans, expansion plans are, and how you plan to close that valuation gap over time.
Yeah, so I mean, building infrastructure, we think there will be market consolidation for sure in infrastructure. So building more base stations next to existing good base stations makes no sense. We've chosen a capex light model, so we have roaming arrangements with two very good partners, and we get quality of service right up front. So we've swapped capex for opex, and as a result of that, you are able to give access to 28,000 base stations. So really good quality right up front. That allows you to then unlock capability through your distribution channels. We've got an exciting MVNO business. We're very deliberate and intentional about that. So if you look at the position, we have swapped capex for opex. We've got the traditional lines of business that we think we'll do very well in. We're at the beginning of a journey when it comes to our MVNO positioning. Very strong, great partners giving us access to that market segment that otherwise you would not be able to get access to with your own brand directly. We've got some fantastic enterprise partners. We've revamped nearly 70 of our stores. So we've got a completely new look and feel. We've refreshed the brand in August of last year, invested a lot into systems. So we really think we're very well positioned for some growth. And putting the customers and our business partners at the center of everything that we do, I think will deliver unbelievable value into the future.
Okay. And George, now that you've officially separated from Blue Label, tell me more about what Cell C will benefit, since that, given the fact that you will now be operating as an independent entity.
Well, it gives Cell C its own positioning in the market, right? So if you want to invest in Cell C before, you could only do it via Blue Label. And they're a great organization, and they've been very, very supportive. They've been key to making sure that this is possible. They have invested heavily in Cell C. They have kept Cell C going for a number of years. And so this was just the natural next step, is to put Cell C into the public so that you can invest directly. An opportunity for us to showcase what we can do as Cell C in a transparent way, in the public space. And I think that will be the biggest opportunities that you can now invest. We've got access to capital markets like any other organization. We've been unshackled, so to speak, from the way we were structured, not necessarily from an investor point of view in the form of our shareholder. They've been great, and I wish them the best of success. Of course, we'll continue to engage. They're not going anywhere. They're still a significant shareholder in Cell C. So we're looking forward to an opportunity to be in the public space.
And those were some of the stories making headlines in the South this week. It's back to you, Akin.
Thanks, Karabo. A beautiful evening to you, Tabitha. What's cooking in East Africa?
Hello, Akin. It's been another week of developments in the region. We start in the Horn, where Somalia is open for business. Fresh off debt clearance and backed by a renewed external support package, the country is charting its return to global markets. We spoke to Central Bank Governor Abdurrahman Abdullahi for more.
Somalia is back on the global financial map with a strongly reduced debt level, credible reforms, and as you know, through the debt relief with IMF, we have one of the best debt burden to GDP, around 6% of our GDP now. with that, we have also carried out a number of reforms, not only in the financial sector, but also of all public finance institutions. We have very strong reform of the Ministry of Finance, and we have more than doubled the revenue, domestic revenue, for the last 3 years. And central bank is supporting through sustained reforms in the area of building payment infrastructure, digitalization, supporting the young private sector, both banking industry and also mobile payments and other payment service providers. This year also we have added to new sectors like the insurance sector, which has been brought under the central bank regulation for the first time since the Civil War. And we have also licensing now the microfinance sector, which is will offer a much needed credit to those who are underserved by banks.
That's great. Thank you for sharing that. Insurance and microfinance coming into the fold of the central bank. That is very interesting. But let's first start with, everyone's talking about currency reform. And the last time when we spoke, which was in July 2025, you outlined plans for a dual currency system, and you were working with the World Bank and IMF to introduce a strict currency board and, of course, reintroduce the Somali shilling. What progress has been made on that front, and how do you see it stabilizing the Somali shilling, which in the recent month has seen some pressure?
We are still working on that project. It's a significant project to boost the stability of the currency with a currency board arrangement included. We also provide financial inclusion for those small businesses and individuals that are currently not part of the financial system. Because, as you know, our economy is largely dollarized, and those who are still using the old and mutilated Somali shilling are not part of the formal financial system. So what we are planning is to replace the current old Somali shilling in circulation with a genuine, secure, central bank issued currency.
Coming back to the east, Kenya's Q2 2025 trade shows exports up 1.7% to 280 billion Kenyan shillings. Imports up 5.7% to 693.6 billion shillings, widening the trade deficit to 413.5 billion shillings. We spoke to Jaswinder Bedi, who is the chairman of the Kenya Private Sector Alliance, on what these trends mean for the economy, key sectors, and policy priorities.
If you look at our statistics on exports from Kenya, actually our numbers from 2023 to 2024 have actually grown by $1 billion. So our current exports stand at 8.3 billion in goods, and our current exports on services stand at about $8 billion. So whilst we have a deficit on goods, which is a $12.8 billion deficit, with our imports being over that same period $20 billion, we've actually had a surplus in services of $2.4 billion. So we can actually see a trend that Kenya's goods exports are also going up, and also our service export, first time in our history, has actually surpassed imports. So which is actually a good place to be. And if you really look at how our macroeconomic indicators are showing right now, all the macro figures for Kenya are very, very encouraging. We have a stable exchange rate for the last 16 months or so. We have very low inflation in the country. At the same time, we have an import cover, which is more than $11 billion, which is more than 6 months import cover. And what we have also seen in the last 12 months is Kenya has become the 6th largest economy in the continent, with, of course, the highest FDI growth on the continent. So yes, the macro picture is very good. What we are noticing on the ground is a total disconnect between the macro and the micro picture. And I think that's the next phase when we start seeing macroeconomic indicators distilling down to the micro indicators on the ground. There is some pain on the ground, but I think that's only short-lived. So all in all, in a good place to be.
Indeed. And how much of this growth can we say is being driven by traditional commodities versus the re-exports here?
Well, there are a lot of re-exports, especially in the petroleum sector where we are selling in the region, but also the region is growing, as you can see. You know, we have now East Africa community, which is 8 countries, and within 8 countries, we have 330 million people, combined GDP of $310 billion. Kenya is about 35% of that combined GDP. We're at $130 billion. And yes, so we are looking at expanding our business in the region. We're looking at expanding the rail, the road. His Excellency, the President, is actually opening up this new dual carriageway, which will be from Mombasa to Malaba tomorrow. And of course, we're extending the pipeline from Eldoret to Uganda. So there will be a lot of petroleum exports in the region, and it'll just get a lot of trucks off the roads as the fuel starts moving away from trucks into the pipeline.
Yes, and looking at the macros and the micros that we are seeing there, Jaswinda, let us look at the sector performance here in terms of, we are seeing coffee, horticulture, and even oils posting strong gains, whereas the exports such as, titanium ores, salt, and even cement are seeing a decline. So then, how can Kenya reduce vulnerability to sector-specific fluctuations and at the same time strengthen the export resilience?
I beg your pardon. Are you saying that there's been a decline in cement exports and an increase in coffee and petroleum exports?
Yes, from the sector performance, yes.
Well, if you look at coffee, the export increase in coffee was primarily to do with price of coffee. As we all know, Brazil's crop last year was not very good, and we've seen a huge growth in East Africa, including Uganda. Uganda's coffee exports went up to $800 million, and ours also went up purely because the global price went down. Also, Ethiopia's exports of coffee went up.
From Somalia to Kenya, that's your regional update. Back to you.
And now to stories from West Africa. The Monetary Policy Committee of the Central Bank of Nigeria has kept the monetary policy rate at 27%, citing sustained disinflation and improved macroeconomic stability. Speaking at the November committee meeting, Governor of the Apex Bank, Olayemi Cardoso, adjusted the asymmetric corridor at plus 50 to minus 450 around the MPR, while leaving other parameters constant. Take a listen.
The committee reviewed key developments in the global and domestic economies, including the risks to the outlook. All the 12 members of the committee were in attendance. Decisions of the MPC. The committee decided by a majority vote to maintain the current monetary policy stance with an adjustment to the corridor as follows. 1. Retain the monetary policy rate MPR at 27%. 2. Adjust the standing facility corridor around the MPR at plus 50 to minus 450 basis points. 3. Retain the cash reserve requirement, CRR, for deposit money banks at 45%, merchant banks at 16%, and 75% for non-TSA public sector deposits. And 4, keep the liquidity ratio unchanged at 30%. The committee's decision was underpinned by the need to sustain the progress made so far towards achieving low and stable inflation. The MPC reaffirmed its commitment to a data-driven assessment of developments and outlook to guide future policy decisions. Considerations. The committee welcomed the continued deceleration in headline inflation year on year in October 2025 for the 7th consecutive month. This favorable development resulted from several factors, including sustained monetary policy tightening, stable exchange rate, increased capital flows, and surplus current account balance. In addition, the relative stability in the price of premium motor spirit, PMS, and improved food supply supported the pace of disinflation. However, headline inflation remains high at double digit, requiring sustained efforts towards moderating it further.
Meanwhile, the Bank of Ghana's latest near-term forecast shows that inflation will continue to decline and settle between 6 to 8% by the end of the year. Now, this follows the Monetary Policy Committee's decision to lower the monetary policy rate further by 350 basis points to 18%. Magbedu Abuachi, CEO of Ghana National Chamber of Commerce and Industry, unpacked the MPC's latest decision. Take a listen.
It's a very good news for us as businesses. Over the years, I think for the past 2-3 years, we've had a very high policy rates. We got as high as 30%. And you know how the policy rate affects the lending rate. So once the policy rate was 30%, we had lending rates hovering around 35%. So as a chamber, we have consistently been advocating for a reduction in the policy rate. That's what we have been doing. So at the beginning of the year, we've seen a significant drop in the policy rate. It came as low as 21.5, and then just as you mentioned, the MPC yesterday announced a further cut in the policy rate by 300 basis points, 1050 basis points to 18%. We are keenly hoping that the banks will also follow suit and lower their lending rates so that businesses can now have access to credit at a lower rate. But one of the reasons why businesses are suffering, let me put it that way, is a very high lending rate in Ghana. I mean, if you have a business borrowing at 35%, then obviously it takes purely a magic for a business to make profits aside other costs of doing business. So we are happy and hoping that it will come down further. If you listen to the governor, obviously he has a target of 10% for the lending rate, which means that the policy rate will have to also come down further. If you see the effect of policy rates on business and also on the banks themselves, once the policy rate is very high and the lending rate is high, the non-performing loans of the banks are also high in line with that. So a loan of about 22%, which is, I think, one of the highest in the whole of Africa. So once the policy rate comes down, lending rate comes down, businesses will be borrowing at a lower rate and they will be able to also pay back their loans. And this is also as a result of the a very conducive macroeconomic environment that we are experiencing now. If you take inflation, as you said, for instance, by close of 2023, our inflation was around about 54%. At the end of 2022, it was 54%, the highest we have experienced for a long time now. But we started a very consistent disinflation process at the beginning of 2023. So we saw inflation coming down to 23.5 at the end of 2024, and it continued up to now. So as I speak to you, as you said, inflation is 8%, but in Ghana we have an optimal 8% plus or minus 2. So the target is to get between 6 to 10%, taking care of 8% plus or minus 2. So if you are in 8% and looking at the inflation process, the fact that our CD has appreciated strongly, the fact that we have a very strong the fact that our target for revenue and expenditure, fiscal policy is also working in line with the monetary policy. We are hopeful that the 6% will be achieved in the
Mark,
at the end of the year.
And talking about the overall ease of doing business in Ghana at this moment now, let's talk about the GNCCI's take on the VAT regime as it is, looking at the key aspects, the tax aspect of the 2026 budget, which was presented about a fortnight ago. Your take around this, and then when we look at the bigger picture of the 24-hour economy, how much of opportunities lie ahead, and then when we're looking at the outlook for the market as a whole?
Well, so the VAT, our VAT structure, prior to the announcement in the last budget and this budget, was one of a very complicated one. Structure that is so difficult for ordinary business person, because I have a lot of SMEs in Ghana, even to compute. So as a chamber, we've had a lot of intense advocacy for the VAT structure to be reformed.
And that's all we can take on this episode. You can catch all these stories and more on our website on cnbcafrica.com. Thank you for joining us today. Until next time, stay informed and stay ahead with Africa Business Weekly. I'm Akin Obakeye. We'll see you again, same time next week.